good morning, everyone. It is 9:09 in the morning of October 5th, 2022, and this is my pre-market strategy session. Thanks for tuning in. Looks like yesterday's video got a little bit more views than normal. So yeah, that 280.07 price support and resistance line did come into play yesterday, and it actually acted as support after the markets broke through above it, which is, I can't say it's unexpected. It just, it is what it is. So yesterday here, we'll go back. I just put that line back in. So here we are on the 10-minute from yesterday. The markets were overbought prior to the, into the pre-market. Markets were overbought, and it went further into overbought, came back down, closed below that 280.07, then popped back up above it again, and spent the rest of the day above it. And really, and there's some pretty strong buying going into the close there, you can see. And I don't, really make much of one day's contrarian move to the overall trend. Here on the daily, you can see this bottom red line right here. I have that as the neckline to a head and shoulders pattern, and the price is going to track that neckline for an extended period of time. We are in bearish conditions, and I'll show you. This is Alibaba, and I put this neckline in back here starting in roughly November of 2020. And you can see price, although price did deviate, significantly, and considerably from the neckline, it has still predicted the overall trend for BABA. And it looks to me like the Qs are setting up for the same kind of thing here. This neckline down here. Let me actually just make this one go away. Make this line go away. Let's see, where is it? There it is right there. So the Qs are setting up to do something quite similar to what BABA has done with its neckline. So there is going to be an extended period of downward movement tracking along roughly with this neckline right here. The blue line, I had that at October 11, but now I've moved it over to October 14th. That's going to be the start of earnings season. And earnings are forecast to sorely disappoint, which, is kind of what happens in the when the third quarter is reported. Third quarter earnings are going to get reported on October 14th, which is they're going to start getting reported, and that is 2 weeks into the fourth quarter, last quarter of the year. Economic forecast is bearish with forecast of shrinking GDP. And actually, the inflation is forecast to decelerate. So although inflation will still be considerably high, it's forecast to start coming down from 8s into the 7s. We'll see. In really, though, either case, it's going to be bad news for the market, even if it's slowing. If the it's a double-edged sword. The slowing rate of increase in inflation is actually a negative for the market, even if it is coming from up high to down low. But if it's still high, that means that the Fed is going to remain hawkish. So it kind of doesn't matter, either way you slice it. The slowing rate of inflation, which some would say, okay, well, the Fed is going to start going neutral or something like that. Well, it's not really true. If inflation is still, above 6%, and the overnight rate, the Fed funds rate, is still below inflation, that means that the Fed is going to still remain hawkish on rate hikes. So, and then shrinking GDP, of course, is shrinking GDP, and that means tighter margins during earnings season, lower earnings per share, lower revenues, so on and so on. And so I think between now and where that blue line is, we've got almost 2 weeks left. Let's see, 7 more trading days, about a week and a half left until earnings season kicks off. I think it's going to be at earnings season where we really start to see a lot of the continuation of the downward move in the Qs, specifically the Qs. The SPY is tracking quite similarly. However, the percentage rates are lower on the SPY than on the Qs, so we're going to get more dramatic moves on the Qs than we will on the SPY. VIX is elevated. I believe it's going to remain elevated for a considerable amount of time. I'm talking like between 9 and 15 months from now. We'll probably see the VIX stay above 20 for that entire period. It's the VIX is not coming down. There is fear in the market. Short term, day by day, it's really hard to say. Here's the 10-2 yield delta inversion. The pink line here is 0, and so right now the 2-year yield will yield 432 basis points greater than the 10-year yield, so it is inverted. And one thing that I just always mention whenever I bring up this chart is that the yield curve can stay inverted for a long time. It was 12 months back here and before the 2001 crash, and 18 months before the 2007 crash. It stayed inverted, and it wasn't until the yield curve started to normalize that we started to see the big down legs in the market. And so what that kind of means is that once we're already headed into a downturn, and then once the yield curve starts to normalize again, then we're going to see the real downturn. So long term, I'm talking again between 9 and 15 months from now. We haven't seen the big downturn yet, and we ought to be testing these lows down here. Let's see, just a rough estimate, between now and the next year and a half, roughly. 166 will come into play, and even possibly, 146 will come into play. So, just sort of being patient and waiting for the best setup is the thing to do. And right now, the best setup isn't really revealing itself at this very moment. There's a saying on Wall Street: markets crash from oversold conditions, and so we are opening up into oversold conditions this morning on the 1 minute and the 10 minute on the short time, and on the daily here we are coming out of oversold. So when indicators are rather kind of like incongruent, like they're not simultaneously moving out of oversold or moving out of overbought, it just tends to be bullish. Things tend to move in the up direction. Now I think that's a possibility. We could see that going up into earnings season just to set up for the next leg down. And this leg down right here, according to Elliott wave theory, this leg down right here ought to take us from here at 334 down to about 240, right? So and nothing moves in a straight line, of course, and so the past 2 days rally, which has been almost a 6% rally from the bottom on the 30th of September at the end of the quarter to yesterday, has been almost 6%. So I'm just going to sit back and wait really for the best setup. And I think that setup is coming once we start hitting earnings season. That's probably going to be, and once everything starts to get congruent, once the daily lines up with the daily RSI, lines up with the 10-minute RSI, lines up with the 1-minute RSI, while simultaneously lining up with the same RSI time periods on the VIX. So right now the VIX on the daily is coming out of overbought. The cues on the daily are coming out of Oversold. So for the next couple of weeks, it wouldn't surprise me to see an up leg over the next couple of weeks, and then that's just setting us up for the next leg down into the 240-ish range on the cues. So if I trade today, it will be a very short term. Very short term. I'm looking for bearish setups, although I think that in the short term, things are going to be bullish going into earnings season. So I probably won't trade much now between now and the next, 7 trading days, unless things really set up at the top end of the ranges for a bear trade. Not a heck of a lot, to report this morning, really. Yesterday's price level, it was a good price level to watch. I didn't trade it, so I just kind of was butt in seat for most of the day, and I didn't get a good juicy setup for a bear trade yesterday. And that's kind of about it. The next time I post a price level, though, the only time I ever post price levels is when I have a high degree of confidence in it being a support and resistance line. So, yeah, all right. Good luck out there, everybody. Keep your risk tight. Click like, share, subscribe, leave a comment, tap the bell. Thanks for tuning in. And I will see you at tomorrow morning's strategy session. I am out.